All right, everyone, welcome back to the AG Insider. I'm Captain Silver, and we need to talk about what Wall Street just leaked because this is the mathematical equation that will absolutely destroy the paper silver market. A senior portfolio manager has finally admitted on record what happens when the trillions of dollars currently trapped in the massive artificial intelligence and tech stock bubble rotate into the microscopic precious metals sector. They're calling it the 5% tsunami. And when this inevitable rotation hits the physical silver market, the current $83 paper price will look like the greatest financial joke in human history. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. But let me ask you right now, are you still gambling your wealth in overvalued tech stocks? Or have you already rotated into physical silver before the institutional herd arrives? Let me know your exact portfolio strategy in the comments below because I need to understand who has already positioned themselves ahead of the tsunami and who is going to be left scrambling when the rotation begins. Let me break down the math of market capitalization because this is absolutely critical to understanding the scale of what's about to happen. Right now, the entire world is obsessed with semiconductors, artificial intelligence, and mega-cap tech stocks. Trillions of dollars are stuffed into a handful of overvalued companies. Nvidia has a market cap of over $3 trillion. Apple is over $3 trillion. Microsoft is over $3 trillion. These three companies alone represent over $9 trillion in market capitalization. Add in Amazon, Google, Meta, Tesla, and the rest of the Magnificent Seven, and you're looking at over $15 trillion concentrated in just 7 stocks. Now add in all the other AI and tech companies, all the semiconductor companies, all the related ETFs, and you're looking at tens of trillions of dollars invested in this sector. But here is the terrifying reality Wall Street just realized. The entire gold and silver mining industry is so fundamentally tiny that it mathematically cannot absorb this capital. Let me give you some specific numbers. The total market capitalization of all the publicly traded gold and silver mining companies in the world is approximately $250 billion. That's billion with a B, not trillion. The entire precious metals mining sector, including gold, silver, platinum, palladium, everything, is smaller than the market cap of a single large tech company. Nvidia alone is worth more than the entire global precious metals mining industry combined. This is the microscopic market that institutional investors are about to discover. Now, let me tell you what a senior portfolio manager from Ninepoint Partners stated clearly. He said that institutional investors do not even need a 10% allocation to break the market. Just a tiny 5% rotation of capital from tech equities into metals will create a demand tsunami that instantly wipes out the available supply. Let me do the math for you so you understand the scale. If just 5% of the $15 trillion in the Magnificent Seven stocks rotates into precious metals, that's $750 billion. The entire precious metals mining sector is only worth $250 billion. That means a 5% rotation would be 3 times larger than the entire market cap of the mining industry. The mining stocks would go vertical, but more importantly, the institutional investors would quickly realize that they can't actually buy enough mining stocks to deploy that much capital, so they would start buying physical metal directly. Now apply this specifically to silver. Silver is the physical, highly conductive backbone of the very AI and tech sector these funds are investing in. Every AI data center requires massive amounts of silver. Every semiconductor chip requires silver. Every solar panel requires silver. Every electric vehicle requires silver. The tech investors are making money on companies that depend on silver, but they don't own any silver themselves. When they realize that there's a structural deficit in the silver market, when they realize that the industrial demand is exploding while the supply is constrained, they are going to want to own the actual metal, not just the stocks of companies that mine it. And here's the key point. When the smart money realizes there is a massive physical deficit, they won't just buy the mining stocks. They will aggressively hoard the physical metal. We're already seeing this with some hedge funds and family offices. They're buying physical silver and taking delivery. They're bypassing the paper market entirely and going straight to the source. They're locking up supply with long-term contracts. And when the institutional herd follows, when the pension funds and the sovereign wealth funds and the mutual funds start allocating to physical silver, the supply is going to vanish. Let me explain why a microscopic market cap absorbing trillions in tech profits is the exact mathematical definition of a historic, uncontrollable short squeeze. The total above-ground supply of silver available for investment is estimated at around 2 billion ounces. At $83 an ounce, that's a total market value of about $166 billion. That's the entire investable silver supply in the world. Now, if just 5% of the capital in the Magnificent Seven rotates into silver, that's $750 billion chasing $166 billion worth of metal. That's 4.5 times more demand than there is supply. The price would have to go up by at least 4.5 times just to balance supply and demand, assuming no one sells their existing holdings. But in reality, most silver holders are not going to sell at any price because they understand the long-term value. So the price is going to have to go up much more than 4.5 times to incentivize enough sellers to come to market. Now let me talk about the tech bubble and why this rotation is inevitable. The AI and tech sector is massively overvalued. The valuations are based on expectations of future growth that may not materialize. Nvidia is trading at a price-to-earnings ratio of over 60. That means investors are paying $60 for every dollar of earnings. Historically, that's an extremely high valuation that's only justified if the company can sustain very high growth rates for many years. But there are signs that the AI boom is maturing. The easy gains have been made. Competition is increasing. Regulation is coming. And the law of large numbers means that it's harder for these companies to keep growing at the same pace when they're already so large. Smart investors are starting to realize that the risk-reward in tech stocks is not attractive anymore. They've made huge gains over the past few years, and now they're looking to take profits and rotate into other assets that offer better value. And the precious metal sector is screaming value right now. Gold and silver are undervalued relative to their historical norms, relative to the money supply, relative to inflation, and relative to the geopolitical risks. The mining stocks are trading at depressed valuations with low price-to-earnings ratios and strong cash flows. And physical metal offers protection against currency debasement, inflation, and financial system instability. It's the perfect place for capital to rotate into after a tech bubble. Now let me talk about the portfolio manager's comments specifically because this is coming from someone inside the institutional investment world. Ninepoint Partners manages billions of dollars, and their portfolio managers have access to research and data that retail investors don't see. When a senior portfolio manager goes on record saying that a 5% rotation would break the precious metals market, that's not hyperbole, that's a mathematical fact. They've done the analysis, they've looked at the market caps, they've calculated the supply-demand dynamics, and they've concluded that the precious metals sector is so small that it cannot absorb a meaningful allocation of institutional capital without massive price appreciation. And here's what's really important. This portfolio manager is not the only one who has figured this out. There are other institutional investors who are quietly positioning themselves ahead of this rotation. They're not announcing it to the world. They're not telling their competitors, but they're buying physical metal and accumulating positions before the herd arrives. And when the herd does arrive, when the rotation becomes obvious and everyone tries to get in at the same time, there's going to be a feeding frenzy. The price is going to gap up, the supply is going to disappear, and the people who waited too long are going to be left behind. Let me talk about the difference between this rotation and previous precious metals bull markets. In the 1970s, when gold and silver went parabolic, the capital that flowed into the sector came primarily from individual investors and some hedge funds. The amounts involved were relatively small compared to the total global financial markets. But today, we're talking about trillions of dollars in institutional capital that could potentially rotate into precious metals. Pension funds, sovereign wealth funds, mutual funds, endowments, insurance companies, all of these institutions manage enormous amounts of money. And if they decide to allocate even a small percentage to precious metals, it's going to dwarf anything we've seen in history. Now let me talk about the specific mechanics of how this rotation will happen. It's not going to be a smooth, gradual process. It's going to be violent and disruptive. Here's why. When institutional investors decide to rotate capital, they don't move slowly. They have mandates, they have benchmarks, they have performance targets, and they have to deploy capital quickly to capture the trend. So what happens is that one or two large institutions start buying, which pushes the price up. That attracts the attention of other institutions who start buying because they don't want to miss the move. That pushes the price up more. Then the algorithms and the momentum traders see the price action and they pile in. Then the retail investors see the headlines and they start buying. And before you know it, you have a full-blown mania where everyone is trying to buy at the same time. And here's the problem with silver specifically. Silver is not like stocks where you can just create more supply by issuing new shares. Silver is a physical commodity with a finite supply. The amount of silver that exists above ground is fixed at any given moment. You can't print more silver the way you can print more money or issue more stock certificates. When demand exceeds supply, the only way to balance the market is through price. The price has to go up until enough sellers are willing to part with their metal. And in a mania, when everyone wants to buy and no one wants to sell, the price goes vertical. Let me give you a historical example of what happens when a small market gets discovered by institutional capital. In the early 2000s, the art market was relatively small and illiquid. Then wealthy investors and institutions started buying art as an alternative asset class. Prices for contemporary art went up by 10 times, 20 times, 50 times or more. Some artists who were selling paintings for $100,000 were suddenly selling for $10 million. The same thing happened with rare coins, with vintage cars, with rare wine. When a small illiquid market gets discovered by large amounts of capital, the prices explode because there's not enough supply to meet the demand. And silver is much smaller and more illiquid than any of those markets. Now let me talk about why silver specifically is going to benefit more than gold from this rotation. Gold is already a mainstream asset that institutions are familiar with. Central banks hold gold. Pension funds allocate to gold. There are gold ETFs with hundreds of billions of dollars in assets. Gold is already somewhat institutionalized, but silver is still the Wild West. Most institutions don't have significant silver exposure. Most pension funds don't own silver. Most central banks don't hold silver reserves. Silver is the undiscovered asset. And when institutions start looking at the fundamentals, when they see the industrial demand growth, when they see the supply deficit, when they see how small the market is, they're going to realize that silver offers much more upside potential than gold. Let me talk about the industrial demand angle because this is what makes silver unique. Gold is primarily a monetary metal. It doesn't have much industrial use. So the demand for gold is driven mainly by investment and central bank buying. But silver is both a monetary metal and an industrial metal. The industrial demand for silver is growing rapidly due to the electrification of the economy, the AI revolution, the renewable energy transition, and the defense buildup. This industrial demand is inelastic, meaning it doesn't go away when the price goes up. Industrial users need silver to manufacture their products, and they're going to buy it regardless of cost. This creates a floor under the price and ensures that the supply deficit continues to widen. Now let me talk about the supply side because this is the other half of the equation. Global silver mine production is essentially flat. The major silver-producing countries are Mexico, Peru, China, Russia, and Australia. None of these countries are significantly increasing production. In fact, production in some countries is declining due to depleted reserves, lower ore grades, political instability, and social unrest. There are no major new silver mines coming online in the near term. It takes years to discover, permit, and develop a new mine. The supply is constrained, and it's not going to increase fast enough to meet the exploding demand. And here's the kicker. Most silver is produced as a byproduct of other metals like copper, lead, and zinc. Only about 30% of global silver production comes from primary silver mines. The other 70% comes from mines that are extracting other metals, and silver is just a secondary product. This means that silver production is tied to the economics of those base metals. If copper prices drop, mining companies cut back on copper production and silver production drops as a byproduct. The miners don't have much control over silver production because it's not their primary focus. This creates a situation where the supply is inelastic and cannot respond quickly to changes in silver demand. Now let me talk about what you should be doing right now. You have a generational window of opportunity. The mainstream retail crowd and the massive institutional funds have not entered this trade yet. They are still holding the bag in the tech bubble. They're still chasing the AI narrative. They're still buying overvalued tech stocks at all-time highs. But the smart money is already rotating. The hedge funds are buying physical silver. The family offices are accumulating positions. The savvy retail investors are stacking ounces. And when the institutional herd wakes up and realizes what's happening, it's going to be too late for them to get in at reasonable prices. You need to front-run the 5% tsunami. Use this engineered $83 paper dip to secure your physical silver ounces locally. Go to your coin shop. Call a reputable dealer. Buy silver eagles, buy silver rounds, buy silver bars. Take delivery, store it securely, and hold it. Because when the tech money realizes they need hard assets to survive the fiat collapse, when they realize that their overvalued stock portfolios are going to get crushed in the next market downturn, when they realize that silver is the most undervalued asset on the planet, the retail physical supply will vanish overnight. The dealers will be sold out. The mints will have year-long waiting lists. The premiums will be in the triple digits. And if you don't already own physical silver, you're going to miss the entire move. Let me talk about the timing of this rotation because people always want to know when it's going to happen. The truth is, it's already starting. We're seeing the early signs. Tech stocks are becoming more volatile. The valuations are getting questioned. Analysts are starting to downgrade the sector. Smart money is taking profits. At the same time, precious metals are showing strength. Gold is at all-time highs. Silver is breaking out. The mining stocks are starting to rally. These are the early signals that the rotation is beginning. But the big move, the tsunami, is still ahead of us. That's going to happen when the institutional capital starts flowing in size. And once it starts, it's going to accelerate rapidly. The great capital rotation has officially begun, and the COMEX cannot print enough paper to stop it. You need to hit the subscribe button and turn on the bell notification right now so you receive my emergency broadcast the exact second this institutional money floods the silver market and triggers the ultimate price explosion. This is not optional. Your financial survival and your ability to participate in the greatest wealth transfer of this generation depends on being informed and being positioned ahead of the crowd. Subscribe now, turn on notifications, and prepare for the 5% tsunami. If you want to understand the terrifying reason why the global mining industry is mathematically incapable of producing more silver to meet this incoming demand, you must click the video on your screen right now. I expose the decade-long supply shock that Wall Street is hiding. Do not wait. Click right here and I will see you in that video.